Do you actually own what you think you own? This is not a philosophical question. It determines how close your understanding of the word asset is to reality. Today we start with the most fundamental question, one almost no one has ever answered clearly. When you buy a stock, what exactly did you buy? You tap a screen. 100 shares of Nvidia. Your balance drops. Your position number rises. The trade looks complete. But behind that moment sits a fact most people never think about. For the vast majority of US listed securities, you are not the directly registered owner on the issuer's books. What you hold is a beneficial interest, expressed through a chain of intermediaries. This is not a conspiracy. This is the foundational architecture of modern securities markets. What we are about to disassemble is the deepest layer of this machine, clearing and settlement. Global financial markets process a staggering volume of transactions every single day. The completion of those trades does not rest on a single click. It rests on an entire infrastructure that confirms, nets, guarantees, and settles. The most critical node in that infrastructure is the clearinghouse. It does not create money, but it determines whether a trade can reach final settlement. The collapse of Lehman Brothers in 2008 had no single cause: credit contraction, collateral pressure, counterparty withdrawal, market liquidity fracture. Each of these forces converged to bring it down. In the aftermath, regulators understood something with new clarity. Some financial infrastructure is not too big to fail. It is too central to fail. Any transaction reduces to two steps: a promise and delivery. You agree to give me 10 apples. I agree to give you 8 oranges. We hand each other the goods. Done. But scale that exchange to global financial markets, and face-to-face delivery becomes impossible. The objects are no longer apples and oranges. They are government bonds, equities, derivatives, and cross-border capital flows. So the financial world invented the ledger. The ledger does one thing. It records who owns what and who owes whom. But ledgers need administrators. In the US securities market, that administrative role belongs to an interlocking system of registration, custody, and clearing, at the center of which sits one of the most consequential nominal holders you have never heard of, Cede Co. When you buy a stock, you do not receive a paper certificate with your name on it. The security is registered in the name of a nominee holder. You are defined, in law, as the beneficial owner. This answers the question of record keeping, but it leaves open a more important question. If a counterparty defaults, who absorbs the loss? The answer is the central counterparty, the CCP. A CCP inserts itself into the middle of every trade. It becomes the buyer to every seller and the seller to every buyer. It does not eliminate risk from the market. It concentrates that risk, standardizes it, and allocates it according to rules. That distinction matters enormously. Once ownership becomes an electronic record, a new mechanism becomes possible: rehypothecation. If an asset can be held, custodied, and reused by the intermediary chain, then the same underlying collateral can cycle through the financing market multiple times. In periods of abundant liquidity, this looks like efficiency. But when stress arrives, everyone begins asking the same question simultaneously. Is the underlying asset still there? Who actually holds it? This is why, once the financial system enters a state of stress, the question is no longer simply, are the assets on the books? It becomes, can those assets be proven, delivered, and settled? In time, Lehman Brothers is the canonical case. It did not fall because it ran out of money in any simple accounting sense. It fell because the financing chain and the settlement chain contracted simultaneously, until it could no longer meet the market's liquidity demands. In a crisis, what kills is rarely the net asset position. It is the closing of the settlement window. When that window shuts, no balance sheet number guarantees cash in the real world. A clearinghouse performs 2 core functions. The first is netting. If JP Morgan owes Deutsche Bank $1 billion, while Deutsche Bank owes JP Morgan $950 million, the system doesn't need to move $1.95 billion in gross flows. Through netting, only $50 million actually transfers. At market scale, this compression of settlement flows is not a minor administrative detail. It is what makes the system physically possible. The second function is risk mutualization. When a clearing member defaults, losses are absorbed in a predetermined sequence. The default waterfall. First, the defaulter's own margin is consumed, then the clearinghouse's own capital. Finally, if needed, surviving members may face assessment. This is mutualization. It means participate in the system and you participate in the system's tail risk. Think of it as an insurance pool. On a normal day, everyone pays a modest premium, but let a default large enough materialize, and every participant's capital is potentially in play. This is why a clearinghouse is not a safe zone. It is a place where risk is managed more visibly, more centrally, and with greater discipline. The distinction matters. Central does not mean safe. It means if this node fails, the failure is immediate, connected, and systemic. That is precisely why these entities are treated as critical market infrastructure, and why the post-2008 regulatory regime demanded that more trades be routed through them, not fewer. Can clearing systems fail? Yes. October 19th, 1987, Black Monday, the S&P 500 and the Dow Jones experienced their largest single-day percentage declines in history. The Federal Reserve publicly committed to providing liquidity and directly intervened to stabilize markets. What is worth studying is not the price decline itself. It is the speed at which the shock transmitted into clearing and financing systems, and the degree to which those systems amplified what followed. Look at a 2018 case study. In certain market segments, the default of a single large clearing member was enough to pierce the default fund, forcing surviving members to absorb losses they had not anticipated and had not priced. This illustrates something structural. A clearinghouse is not a place where fire cannot start. It is a place where, if fire starts, it spreads fast. The architecture concentrates both efficiency and fragility in the same location. You assume your assets exist inside an account, but what actually keeps them functioning is a system you rarely see. Your shares need to be recorded. Your trades need to be confirmed. Your capital needs to achieve final settlement across institutions, and those institutions do not connect to each other by magic. The overwhelming majority of the world's cross-border data travels through submarine cables, not satellites, not wireless. Cables, physical infrastructure on the ocean floor. A single cable fault does not necessarily slow your internet connection. It can interrupt payments. It can delay trade confirmations. It can desynchronize the information flowing between markets on opposite sides of the world. What you see on a screen is never only a number. It is the visible end of a chain. From ledger to network, from institution to physical infrastructure, assets have never been isolated objects. They live inside systems. And some of those systems rest on infrastructure that lies 2 kilometers beneath the surface of the ocean, unmapped by most investors, unmonitored by most regulators, and entirely invisible to the account balance you check each morning. Understand the chain, not just the number at the end of it. Today, we face not one, but 3 concurrent structural shifts. The first is regulatory. The U.S. Securities and Exchange Commission has advanced mandatory central clearing for Treasury securities and repo transactions, with compliance timelines extended to December 31st, 2026 and June 30th, 2027. This means trades that were previously completed bilaterally, off the grid of central clearing infrastructure, are being routed into it. And once inside that infrastructure, margin requirements, risk models, and liquidity demands transmit to market participants far more directly than they did before. The second shift is the unwinding of the yen carry trade. For years, global investors borrowed in low-cost yen, converted to dollars, and deployed into dollar-denominated assets. As Japan's monetary policy environment has evolved, the economics of that trade have deteriorated, and the positions associated with it face real unwinding pressure. When that trade reverses, a mechanical sequence follows. Sell dollar assets, buy back yen, repay funding. That sequence amplifies volatility in assets that absorbed carry capital, and it does so in a compressed time frame. The third shift is the most structural of all. In 2022, Western nations froze the overseas assets of the Russian central bank. That decision, whatever its political logic, transmitted a message to every central bank watching. If cross-border assets are ultimately recorded and enforced through specific settlement networks, then those networks are not merely technical infrastructure. They are institutional infrastructure. And institutional infrastructure can be used as an instrument of state. The response has been methodical. More countries are now actively diversifying settlement pathways, building redundant systems, and continuously accumulating gold reserves, an asset that clears bilaterally and settles outside any single network. This is not a story about tomorrow's rupture. It is a story of structural adjustment that is already underway. March 2020. Panic begins in equity and credit markets, then extends unexpectedly to U.S. Treasury markets. As investors scramble for cash and as leveraged funds face margin calls, even the safest assets get sold, prices fall, margin requirements rise, more assets are sold. This is the spiral. The clearing mechanism does not create the panic, but it ensures that panic transmits faster, harder, more directly, and into cash demands. That is its design. and in extreme conditions, that design becomes the transmission channel. In 2013, ISDA raised the discussion around an extreme tool, VMGH, variation, margin gains haircutting. In plain terms, if a CCP's resources are exhausted in an extreme scenario, the floating gains of winning counterparties could themselves be tapped to fill the gap. This is not daily operating procedure, but its existence in the design literature signals something important. The architects of these systems understood from the beginning that extreme tail risk is not a question of whether it will occur. It is a question of who bears it when it does. We live inside a financial system in which ownership has been redefined. Your shares are typically not registered directly in your name. You hold beneficial interest, not the original registration right. Your pension depends on the continued operation of clearinghouses and custody systems. A nation's dollar reserves depend on the record keeping and enforcement of a global settlement network. These designs improved efficiency, but efficiency has a price, structural dependency. So the question was never only, what assets do you hold? The more important question has always been, through what system are your assets recognized, settled, and protected? Understand that, and the next time this infrastructure shakes, you will not be surprised. We do not forecast prices. We do not predict events. We deconstruct the machine. This channel doesn't offer investment advice. We offer the clearest lens we can grind for watching a world in structural transition. If this perspective sharpened your thinking, a subscription keeps more of it coming. This is Long View. Stay rational. See further. We'll see you next time.